Hi, everyone. This is Emily Platt from the Wellspire Investment Team, and welcome back to Markets in 2 Minutes for the start of 2023. As we look forward to this new year, we thought we'd highlight a few themes from 2022. And with that, really the only place to start would be with inflation. At the beginning of 2022, inflation continued to rise as we saw COVID-related manufacturing closures and supply chain bottlenecks, shrinking labor force participation, and a corresponding growing need for workers, low housing supply, and continued zero COVID shutdowns in China, and a war in Ukraine. When we look at the chart here depicting the changes in cost of goods and services, you can see the cost of goods rise sharply, peaking to over 12% in 2022. More recently, inflation has begun to fall, with goods prices down to around 3.7%. This can be seen when you look to prices of used cars, which are back down to where they were years ago, along with the cost of furniture, where we see a surplus inventory at this point. On the other hand, what still does not look as good is the cost of services. Service costs continue to rise and are not showing a sign of slowing in the near term. A big contributing factor is housing costs, which is heavily dependent on rental prices, which still remain elevated but have begun to slow, but not at the rate of housing prices. Along with this, wages are still high. Major US retail employers continue to see very competitive labor markets, which has meant that average hourly earnings are still quite elevated. Overall, CPI, which was above 9% at the start of 2022, has come down to around 7% today, which is a good development. Inflation pressures in 2022 prompted the Federal Reserve to tighten monetary policy by raising interest rates and shrinking the size of their balance sheet. The degree of the Fed's pivot to restrictive monetary policy startled the financial markets, as we started the year with an expectation that the Fed funds rate would rise to 1% in 2022, but ended the year at 4.5%. We can already see markets pricing in Fed cutting interest rates in 2023, 2024, but there has been a lot of variability in that assumption and nothing from the Fed to say that they'll veer off that path. An overly aggressive Fed is often followed by a recession, the fear of which provides a more likely catalyst for why equities are down as much as they are in 2022. The degree of the Fed's pivot also resulted in pain seen across the bond markets. Fixed incomes, particularly core bonds, have remained under pressure and have not reasserted their status as a safe haven. The more interest rate exposure or duration, the greater penalty in 2022. An increase in rates did push inflation-adjusted bond yields to their highest level in more than a decade, making bonds pretty attractive moving into 2023. As Warren Buffett said, investors should be fearful when others are greedy and greedy when others are fearful. Times like we experienced last year, specifically in the equity markets, can make excellent buying opportunities. Overall, 2022 was a year to remember, and for many, possibly a year to forget. We look forward to helping our clients continue to navigate the markets in 2023 and wish everyone a prosperous year ahead.